Hello everyone, it's Stephen Williams with the creditrepairshop.com. We're going to talk about in today's video inquiries or inquiry. An inquiry on your credit report is where a company, you've applied for credit and they're going to look at your credit reports to see if you qualify to get the credit. There's two types of inquiries on credit. There's a soft inquiry, which is when a company, or actually the bureaus, are selling your information to companies, inviting them to do an inquiry, to do a, let's just say, have you ever gotten a credit card and it said a pre-approval? It's not really looking all the way into your credit. It's just saying that you meet certain standards to have a pre-approval, but then if you want to get the credit, they're going to run a hard inquiry to see if you do get approved. So a soft inquiry, sometimes they show on your credit report and it'll say soft inquiry, or it'll say that these inquiries are promotional inquiries, that they don't hurt your credit score. That's when the bureaus are selling your information to companies and allowing them to take a sneak peek at your credit history. And then if you decide to follow up with them, or if you were looking at credit from another company, they're going to do what's called a hard inquiry, and that's when it will affect your credit score, because when you do a hard inquiry, for some reason the bureaus just feel like they don't want you doing a million inquiries, or I mean, I'm exaggerating, but they don't want you doing a ton of inquiries because it shows that you might have a lack of financial discipline. So let's go into, I just pick these three here because these are the ones that most people are going to have. There's obviously other ones, but let's just go into these and how I'm seeing these affect so many of my clients' credit reports. Okay, so if you went to go for a mortgage, they're going to go to all the bureaus. They're going to check the report. They're going to do an inquiry on all three. And also they're going to do an inquiry with what we consider the third or the fourth credit reporting agency, which has all the public records information. Lexisnexis or Novus, their name seems to be changing, but what they do is they have all the public records, detailed public records, and criminal records, and medical history. And I believe that at some point this company will probably take over most of what these three are doing. Right now, these three are at war with each other, and you can see that they're getting into other products and services, because this company here, what they've actually started doing, they are the leaders in the industry of doing what's called risk assessments. So, and what I mean by that is, someone can do an inquiry on you, and they won't just look at your history on your payment history. They're going to also do what's called a risk assessment on the profile of you on health risk assessment, profile on you on your ability to stay employed type of assessments. And they're not specifically looking at you, but what they do is they build these algorithms of people that if you have a certain group of people that match this algorithm, they can say that this group, this type of individual is either more likely to stay employed, to be a healthy person, or that person is less likely to stay employed and to be an unhealthy person. And companies are going to start making their decisions on lending using that information. But as we stand right now, that's down the line. As we stand right now, if you go for a mortgage, they're going to use those, and usually you're going to see a 5-point drop across the board if you go to use these. It could even be more. We've seen in some cases 15 to 20, but in most cases you're going to see a 5-point drop if you go for a mortgage. And usually that's to the extent of what they're going to do for the mortgage, but what ends up happening on the other side is for the insurance company, for you to be able to get the homeowner's insurance, you're going to have another hit. Some companies may only decide to just look at one bureau, but even if they do, you're going to have another hit, and that's going to make your score drop down, and sometimes that could be another 5-point to 7-point hit. I don't know why they don't always just put this in conjunction together, package it all together, and say just drop the score a little bit for doing the inquiry. But this one, you know, you can't get the homeowner's insurance you can't get the mortgage without having the homeowner's insurance. So they should not penalize you for that, but they currently do penalize you for that. And then, so you see how that whole process works. And then after you get if you get qualified for the mortgage, what we see is you're going to have what I call a bounce. So you'll have a bounce up, because what's going to happen is that they're going to see that you have the mortgage, and it's going to put you into a different class of individuals. When they look at the class of your credit report, they're going to put you into a homeowner's class, and then they're going to rate you on that. And usually we see if you make a few payments, you're going to have that bounce up on there. And then now let's go into auto loans. One big problem that we see is that they'll usually use one bureau, and it's usually going to be TransUnion, Equifax, or Experian. It used to be, depending on what area you lived in, what region you lived in the United States, they would use it. But now, because of like what I said, these companies are at war. They're fighting with each other for business, and they're going to car dealers and they're saying, use us, don't use them, because we'll give you good credit history reports, and we'll give you all this other free stuff for using our service. And so they'll pick one of the bureaus. It could be any one of those three right there. But what the big problem that we keep seeing is that they'll run with the one bureau, but they're going to run multiple finance companies. Multiple. We just did one today where this individual had over 150 car loan inquiries on his report. And when we talked to him, he said that he did talk to 2 dealers. So 2 dealers both put 75 inquiries on his report, and he did not sign to have 150 lenders look at his credit score to see if he could get approved. They need to fix this also, because it tore up his credit score. It tore up his credit score. And the reasons why are the lenders doing this is because what they want to do, especially in the bad credit, or this what's called B and C grade credit, the reasons why they do that is because they make more money when they bring those loans. So what they're doing is basically these 150 places that financial institutions that they sent his loan to get approved, they're bidding on how much they're going to buy the loan from the company. So the car dealer is going to make money selling the car, and also making money selling the loan. So you can see that this is something that they're just always doing, and you need to watch out for that, because if you have 150 inquiries on your report, that's going to dramatically take down your credit score. Now let's move over here to utility. The reason why the utility is very important when it comes to credit scores, because the utility companies, what they're going to do, and we've seen where some of them will go to all, Some of them will report on all three, and some of them will only report on one. It just depends on your specific utility company. But one very important thing that we've seen with utility companies is that they update their information on a monthly basis. They're going to update all the time. So even if you had bad credit and you wasn't able to get a unsecured credit card, in a way your utility bill is like an unsecured credit card, because they're gonna report as if you're paying your payments each month, and if you pay your payments faithfully, you're not behind, that will be a way that you can increase your credit score. And even though we're talking about inquiry, when you get your utility bill, when you get signed up for the utility service, they're going to do an inquiry, but also you can see how the benefits of it will work in your favor. And usually when they do the inquiry, it can drop 5 points. Well, I would say 3 to 5 points. We don't see it drop a lot when people get a utility inquiry, but I can tell you this: if you get turned down for utility service, it's going to hurt your whole overall credit score and your ability to get a loan, because let me tell you how this all works in conjunction. When you're going for a mortgage, one of the filters, and I talk about this in other videos, people say, well, what happened when I went to go get a mortgage? Why was my credit score lower than what it showed on my monitoring service? Why was it lower? It's because each of the companies have filters. And one of the filters, and I've talked about it in previous videos, one of the filters could be if you're a single mom or a single dad, you have 2 or 3 kids, they can count that against you on your credit score in their specific company lending filter. If you have too much debt, they can count that against you in their filter to see if you qualify for the mortgage. But one of the bigger things that they do is if you pay your utility bills on time, because that filter, that specific filter, if you've always had problems paying your utility bill on time, how in the hell are you going to pay a mortgage on time? So you can see how some people think, well, it doesn't matter that I take care of this one, the mortgage company is going to look at me only for the mortgage. That's not true. All of this stuff works in conjunction. The same with getting an auto loan. When the dealers and these finance companies, one of the things that they're looking at in the filter is how you're paying your utility bill. Like I said, if you can't pay a simple utility bill, how are you going to pay a car payment? That means that we're going to have to keep shopping you to all of these people to charge you a higher interest rate to be able to sell you the car. And so it gets into this big trap with people. And then the same with a mortgage company, they can look at, well, what are you paying for your car? Was that a bad, high risk loan that you got for your car? That's going to affect your ability to pay your mortgage. So you can see how all of this works together. Everybody always looks at their credit report and all their stuff that they do singular, and you need to stop doing that. All of these companies are using the information, the data from other companies to profile your type of individual person. That's why I said that with this company here, real quick to close out this video, with the Lexisnexis company, that's going to be the new way. Is what they're going to do is they're going to set these profiles, and they're going to say if you fit these profiles, that you're either a good risk to get a loan or a bad risk to get a loan. And it's going to be forming with, if you had, let's just say for example, you had medical bills, you had trouble paying your utilities, and then you had a high risk auto loan, and then you just with those right there, that they can use the data from all three of those to determine if you're going to get approved for a mortgage or if you're going to get approved for anything in the future. So I hope that this was a very educational video. If you need help repairing your credit, please go to our website, thecreditrepairshop.com, and give us or send us an email if you have a question, or you can comment under this video. Thank you, and until next time.